The news is that the Indian GDP has gone down by 23.9%. What has happened to quarterly results of corporates? Let's compare the two. Welcome back to Be Rich. A strange thing has happened, but it is not so strange if you know how this government operates and how it measures GDP. The result of all 2,170 companies that are listed in the Indian stocks, its revenues exactly dropped 24.1%, just 0.2% more than the combined GDP of this country. Why does this perfect mirror occur? This perfect mirror occurs because the first reading of the GDP is only based on corporate results and some large corporates which are not listed. This does not factor into SME, MSME, and informal sector. Only the second reading and the third reading form or get into the SME, MSME, and the informal sector. The results of the corporates are extrapolated to MSME, SME, and to the informal sector. So the 23.9% GDP contraction is at best a guess estimate. As many economists have pointed out, as the year goes by, you will find GDP contracting between 30 and 35%. As the year goes by, you will find that most of us will find that GDP contracts between 30 and 35%. The net real GDP decline for the entire year will be 11 to 14%. This is a huge drop. The profits in Q1 have not been so badly affected because companies have savagely cut costs. They have laid out people, they have cut costs of discretionary spending, they have cut ad expenditure, and they have been savage in cost cutting. Also, falling crude and steel prices have meant that input costs for most companies have been low. So these guys have reported a small profit in spite of falling demand by cutting costs in employee advertisement and even input costs. But they will find all the cost cutting is front loaded and they will find further cost cutting very difficult to do. The Indian EPS, that is the earnings per share for the top 50 companies, is 359. The last time it was at 359 was the year 2013. The market is nearly double that level. It can be safely expected that the earnings of these companies will drop further, and you can expect earnings to be between 320 and 330 when the year ends. This is going back to 2012 and 2011. If the earnings were 330, which is the best case estimate, then you are nearly going to pay nearly 36 to 37 times earning for markets to remain here. This is not feasible. So markets are not real. They are not in sync with reality. Once the liquidity goes out, the bubble will burst. A lot of retail investors are going to lose their hard earned money. Don't try to catch a falling knife. Thank you for watching Be Rich. Thank you for supporting Be Rich. If you like this video, hit the like button, press the subscribe button of my channel, and turn on the bell notification. It's not important that you only subscribe. It's very important that you get your friends and relatives to subscribe to this channel. If you use Kindle, the Kindle link to the book, my books are given below. You can buy them there. If you want a hard copy, we have given you a WhatsApp number. You send a message and my team will get in touch with you. At the very end, if you want to speak to me directly, please send a mail to berichenglish@gmail.com. Once again, I thank you for supporting Be Rich.